just one of the myriad charts that show the levels of distress and drama that we've seen when it comes to the trading in these Chinese names, be it you look at Hong Kong, mainland China, or over in the US. This chart showing the performance of the long China trade, various large China-focused funds seeing their year-to-date returns turning sour. It's a pretty consistent picture there. What sort of discount would you need to see in some of these names for the buy case to be compelling at this point?
Well, look, I think it's not even about the discount as much right now as it's trying to quantify the underappreciated risks to earnings and risks to credit. And that's the difficulty here, is that it's just very difficult to quantify these risks if we don't really know what's happening. And I think investors in general are scrambling or struggling to try to put a narrative around what is the driving force here. Is it something about trying to have less reliance on foreign capital in general? Is it something about data, or is it something about not investment related like demographics? We're hearing all these cross currents, but it's very difficult to quantify that. And I think long term, if we do believe that a low rate environment, a population that will be using more of consumer driven tech products and will drive earnings, that this is a positive long term story. It's just until we can quantify the near term, it's difficult to come in right now.
So at this point, you can probably say there's two risk profiles, right? One would be a group of companies like education tech where they may not be profitable, they may not exist after this. If you take a look at the other section, which is your Didi, your some of the other Tencent-backed companies, food delivery, for example, they could come through on the other end of this, maybe with big fines, maybe with a more streamlined type of business.
I think that's exactly right. And we've been sort of conflating these issues as one sort of CCP issue on the China stock market, but it isn't. I think that there are a number of cross currents, and we have to, exactly as you said, understand where we might see businesses that are being regulated out and businesses that are just coming back into greater control. Again, difficult to quantify at this point, but that's what investors need to do in terms of finding their discount.
Are there places where investors can take shelter, for example, those sectors that might benefit from President Xi Jinping's policies like EVs and clean energy?
Look, I think that within the energy space, we actually, there are a number of places that we will continue to see investment, better earnings, better opportunities ahead. Even when you look at the China index overall, there's been quite a split between the industries. It hasn't been a kind of a unidirectional trade even within the index. There has been quite a bit of sector dispersion. So these issues they really do seem to be quite regulatory focused. So yes, I do think there are places, including that EV side, which we know is going to get continuous more attention.
And of course, also
just one point on that though. What we don't know is what's coming next, right? And that's another difficult thing with China is, are we moving on to something like more regulation on the auto industry or something like that? This is the very difficult point right now, and why I say it's difficult to come in now, because there might be another story right around the corner in an industry that we're just not sure about. So I think investors are just waiting for this to shake out a bit.